Welcome to the latest episode of Wealth Uncensored. Today I want to talk about the biggest mistake and the biggest potential risk that I see people make when they're looking at expatriation. It's something that I've been helping people expatriate since 2009. Welcome to the Wealth Uncensored podcast, straight talk about everything that impacts your wealth. In each episode, I share what I've learned through my own experience and 2 decades of helping high net worth clients structure their affairs to minimize taxes and protect their assets for the next generation. I'll also feature special guests who are experts in their own field, sharing their knowledge and experience to help you protect what's yours. I'm your host, Jimmy Sexton. Let's dive into today's show. And since then, I've helped countless people expatriate. Hell, I've even expatriated myself. And whenever you're helping a client expatriate, the first goal is to try to see if they're a covered expatriate. Because covered expatriates are subject to an exit tax regime. It's basically a mark-to-market tax on all your unrealized gains. And any U.S. recipients of gifts from a covered expatriate or recipients of inheritance from a covered expatriate are subject to gift or estate tax at the highest rate then in effect, which is currently 40%. Plus, if you're a covered expatriate, sometimes it can be difficult to get a visa to travel back to the United States. So covered expatriate, bad. You don't want to be a covered expatriate because you potentially have this exit tax. Your U.S. heirs or recipients of gifts are going to be liable for U.S. gift or estate tax, and you might have trouble getting a visa to go back to the U.S. If you look at the criteria for being a covered expatriate and you don't meet it, you're a non-covered expatriate, great, there's nothing to do. There's essentially 3 criteria for being a covered expatriate. Either you have a net worth of $2 million or more, you had an annual average income tax for the prior 5 years of more than $201,000, that's an inflation adjusted amount, so that's the 2024 amount, or you're not tax compliant. Even if you are a covered expatriate due to the net worth or the annual average income tax, sometimes you can do some pre-expatriation tax planning to get the client under that threshold so that they would become a non-covered expatriate. There's also some exceptions to being a covered expatriate if, for example, you expatriate before you're 18 and a half or you were born a dual citizen. There's those exceptions that I just mentioned. There's some other criteria that go along with those, but those are basically the exceptions. And so those 2 exceptions will get you reclassified from a covered expatriate to a non-covered expatriate if you were a covered expatriate because of the net worth or the annual average income tax tests. Also, if we can do some pre-expatriation tax planning to get you under the net worth test or under the annual average income tax tests, then you can become a non-covered expatriate. But regardless of what your net worth is or how much tax you paid, your net worth could be 0 and your annual income tax could be 0. But if you're not tax compliant, then you're a covered expatriate. You have to be tax compliant for the 5 years prior to your year of expatriation. If you're not tax compliant for those 5 years and you can't certify that you were tax compliant on Form 8854, you're a covered expatriate whether you like it or not. And even if you believe you are tax compliant and you check the box on Form 8854 and you certify under penalty of perjury that you're tax compliant, and the IRS later were to audit one of those 5 years prior to your expatriation to determine that you weren't tax compliant, guess what? You could then be a covered expatriate because you weren't tax compliant. And this is the biggest risk and the biggest mistake that I see people make when they expatriate. When I advise a client on expatriation, one of the things that I insist on doing is reviewing the 5 years tax returns prior to expatriation to make sure they're correct. And this is a big undertaking because you have to first completely understand the client's tax situation, their income, their assets, pension fund, and then compare that to their tax returns to determine whether or not they're accurate. And I'll tell you something, in the 15 years I've been helping clients expatriate, including expatriating myself, other than my own tax returns because I prepared them myself, I have never, not once, seen a client who has had the prior 5 years tax returns be correct. Never. Not one single time. And I'm going to tell you why. And here's the other interesting thing. Almost every single one of those clients told me, no, you don't need to worry. My tax returns, they're 100% correct. I'm compliant. And I said, no, let me review the returns, or let me have a CPA or an international tax accountant that I trust review them, so that we can make sure that you're completely tax compliant for the 5 years prior to expatriation. Because if your tax returns aren't right for the 5 years prior to expatriation, then you're not tax compliant, you're a covered expatriate. So before you expatriate, we need to go back and fix those tax returns to make sure you're tax compliant. Now, why are none of these clients tax compliant when they believe they are? I'm going to tell you. Because the biggest mistake I see is when clients first, let's say, go international, when they first switch from being a purely domestic taxpayer to someone who has international income and assets, they stick with the accountant that's been doing their taxes all along. And this accountant most likely is not an international tax expert. So this accountant, for fear of losing the business, tries to fumble their way through and do the best they can with preparing the client's tax returns, but they're just not competent to do so. The only people that are competent to prepare international or U.S. tax returns with an international aspect are people that only do that, because it's that complicated. You can't be a jack of all trades. So that's the main reason why I see people's tax returns be incorrect, is because they just stuck with the same account. The accountant didn't know what they're doing. The other reason is because the client tried to save money by hiring the lowest cost international tax preparer, which also they don't know what they're doing. The truth of the matter is, a really good U.S. international tax accountant is expensive. It's gonna cost a lot of money. If you're thinking about expatriating, you need to make sure that those 5 years tax returns prior to expatriation are correct. And if they're not, your accountant, the guy that got you into trouble, isn't gonna be the guy that gets you out of trouble. You need to spend the money and go hire somebody that really knows what they're doing to review those tax returns and to fix them. Because in the 15 years that I've been doing this, like I said, I've never, not once, other than my own returns, because I prepared them myself, have seen somebody planning to expatriate whose tax returns have been 100% correct. Not one single time. So that tells you something. It means if you're thinking of expatriating, your returns probably aren't right either, and you need to get them checked out before you expatriate, because otherwise you could be a covered expatriate not knowing you are, and if you get audited, guess what? You're going to be subject to the exit tax. Your U.S. heirs and recipients and gifts are going to be subject to gift and or estate tax. You might have trouble going back to the U.S. So this is the number one mistake that I see people make when they expatriate, is they assume they are tax compliant, when in reality they are not. And if you're working with somebody on your expatriation and they don't insist on having your returns reviewed by somebody who really knows what they're doing, then you're not working with a good expatriation advisor, because this is something that absolutely should be done. And just in general, even if you're not considering expatriation, if you want to save money in the long run, spend the money now on a good U.S. international tax preparer. It's money well spent, because 99% of the people out there have no idea what they're doing, and they're fumbling their way through it, and it just doesn't work. And in the end, you wind up with penalties and interest and being a covered expatriate when you weren't planning to be. That's all I wanted to talk about today. I hope you've enjoyed this video. Look forward to seeing you on a future episode. Thank you.
Thank you for joining me on Wealth Uncensored, where we help you minimize taxes and protect your wealth for the next generation. If you like our show, be sure to subscribe and leave a review. And if you have any questions or suggestions for future episodes, we'd love to hear from you. You can email us at info@esquiregroup.com. And don't forget to visit Esquire Group's website for more information on how we can help you secure your wealth. I'll be dropping knowledge again next week. Don't forget to join us.